Okay, so good morning, everyone, and welcome to this edition of the Macro Snapshot. We'll concentrate on the CPI today because obviously that's the most important thing. For the record, we are Tuesday, November the 14th, 2023. Okay, guys, so let's immediately just look and see what's expected and why this is important. We know that Powell, when he was talking at the IMF meeting, I think it was last Thursday, he essentially said that in terms of the inflation, there were kind of two things I'd take away. He said that we'd seen some head fakes in the past. So basically, this idea that, maybe inflation seemed to be dipping down, but they couldn't be too certain. And secondly, he said that, a few months of sort of good data on inflation would not necessarily change his mind. So basically, the market took that as being relatively hawkish with this sort of notion that Powell basically wanted to see, several months, consecutive months, 3, 4, 5, 6 months of inflation data heading in the right direction, heading lower to sustainably achieve their target of, towards 2% or so. And they're not there yet. So if we actually look at where we're at, let's just first of all look at the year-over-year numbers here. So you see here the year-over-year number, the headline. Now that is meant to be coming down, which is good news. So prior was 3.7, expected to come down to 3.3. So that's heading in the right direction. But we are still 3.3 is still far away from 2%. And then if we look at the core number, this is the problem. This is really the problem here because it looks as though headline inflation is coming down. But if you look at the core number here year over year, that's expected to remain the same basically at 4.1. So prices are still going up 4.1% year over year at the core number. And like the general narrative here in the bigger picture is that, the easy work, so to speak, of getting inflation down from where was it, 7 or 8% down to, 5, down to 4 is not so difficult. But with the core at 4.1, the Fed is basically, they need this number, especially with the PCE reading, to be, let's call it under 2.5% or so. And we're still a long way from that. Now, just in terms of this month and what we're getting today, obviously we need to be focusing on the month-over-month numbers. Again, it's the same as in the headline. We had this narrative that the headline number is coming down from 0.4 to 0.1. And that's on the back of, gasoline prices have come down quite a lot, and a couple of other components. But the problem here is that the number excluding food and energy, so the core number, is at 0.3. And then also we have to consider what Powell considers the super core number, and Jerome Powell is looking at that. So the super core number is this number of sort of services excluding shelter, and that's the number which he's looking at. So they're kind of the things to be looking at here. So first of all, guys, I just always like to look at what the market's really expecting. So we're just going to look at the month-over-month numbers here. So if we look at the core number here, let's look at the core number. And this is the most important one here. So excluding food and energy. Now, as you can see, the median and the average is at 0.3. This number is rounded up, but actually comes out at 2 decimal places. So it's kind of always interesting if you could pick up on Twitter or LiveSquawk or Bloomberg or wherever you get your news from, just to get a sense of the unrounded number. This is 0.34 is not the same as 0.26, but 0.26 and 0.34 would actually come out at 0.3. So it's good from a trading perspective just to have a sense of the unrounded number. As you can see here, standard deviation's 0.05. So that's something to be considering. But as you can see, there's been about 60, 64 kind of estimates here. The vast majority of them are sort of congregated or concentrated just in the middle around the 0.3. So that really is consensus, although there is a little bit of, sort of a differential. There's 0.2 on the low end as estimate and 0.4. So it's very simple. Anything at 0.2 will be considered low and cool, and anything 0.4 or above will be considered hot. So that's a fairly simple number there. But again, I do urge everyone to look at the standard deviations and the unrounded number to read a bit more detail into that. So if we actually then just look at the headline number, again, that is expected to attenuate. So if that doesn't sort of attenuate and come in softer than last time, that would be quite a unpleasant surprise for the market. Again, if we look at the estimates, about a 2/10 estimate from a low of 0 to 0.2, median in the middle of 0.1. So there it is, a standard deviation of 0.4. So they're the key numbers. So let's just now look at some of the subcomponents and a couple of things to be looking out for on the numbers. I've just got here the M&I report, which is a great report. So as I say, slide in gasoline prices is expected to bring it down. Just in terms of some of the what they're calling the key sequential drivers, we're looking on the upside. So factors which are expected to sort of to boost the numbers. Used cars, the market thinks, well, analysts thinks that the used car prices have basically coming up a little bit. Okay, then health insurance is meant to have gone up a little bit. We'll get to that in a second. Rents, this is an important one here. This is the owner equivalent of rent, is seen slowing to 0.43. That's one I always like to look at because Jerome Powell in the past has spoken quite a lot about that, just the cost of shelter. The range, though, is 0.36 to 0.5. So just maybe you want to jot down somewhere on a piece of paper, 0.43 for the owner equivalent rent. Airfares are supposed to come down a little bit, and if we look at just a couple of other things, so we look at the supercore number, so that's the one excluding kind of shelter, so over owner equivalent rent and primary rents, that actually was a 0.61 in September. And Jerome Powell will not like that because he said that's the one he's looking at. That's the number for him, which is the very stickiest one and the most recalcitrant one. That surged, as I say here, to 0.61. But the new number analysts are expecting is 0.46. So maybe just something you want to maybe look at that. Is that number there. So just have a look at here, guys. So again, this is the summary of analysts. If you want to do a screenshot of this, this has got all the sort of subcomponents with a bunch of banks here and just anything which what were they expecting. But really the ones, apart from the headline and the core number, that's the Bloomberg consensus we just saw. It's this super core number here, which definitely I'll be looking at as 0.46, because that is the one which, all things considered, is probably going to be the primary driver for the Fed, or at least for Jerome Powell, because he wants that number to come down. And just to think about it, if you annualize that month over month, if you annualize that and you multiply it by, whatever, approximately 12 or so, you're getting up towards, what's that, 4.85% or so, well above the Fed's core number, sort of target range. Okay, so in terms of the trading, pretty simple here. Let's just look at a few charts. I would say that actually just a couple of things to look at here before we look at a couple of charts here is why do we care about this number? And basically the idea is that the Jerome Powell came out and the Fed has come out recently saying that they have twin mandates. Employment is great. The employment market is very, very strong, even though it may be weakening just a tiny bit, but it's still, from a secular point of view, extremely strong. So the issue here is inflation, and we all know that their inflation mandate core is down to about 2%. I don't know, 2.25%, 2.5%. And they're still not there. As we saw, we still have a core PCE, around about whatever it is, 3.5%, 4%. So the thing here is that the market is saying, the Fed's done. And you can see here graphically, they're saying the Fed, maybe, a tiny few more basis points, but then essentially they're going to start cutting. So if we first of all look at the cutting cycle here, well, there's two issues. Will they hike again? And Jerome Powell and other Fed members, by the way, we have a bunch of Fed members today. Jerome Powell said that, he reminded us last Thursday that, the bar would be high, they would be cautious. So the bar is high for another hike and they would be cautious. But he tried at least to express the view that, should the data warrant or justify it, he would be happy to do another hike, probably not 2 or 3, but another hike. But the market is disagreeing. So if we look at what's priced in for the next meeting on the 13th of December, the middle of December, we see there's only a 14% chance of a hike, which equates to 3 basis points priced in. Remember, a hike is, priced at 25 basis points, so only 3 basis points priced in. So the market essentially is discounting that. Same thing here for January. The market is saying, there's only 7 basis points priced in, which is a 28% chance, or a 1 in 4% chance. So the first thing to keep in mind is that the market is essentially saying, there's a minimal chance of one more hike. So if we get a hot number, let's say 0.4 on the whatever, just an extra tenth on the two numbers. The first thing to do is that, I don't know about December, but maybe this January pricing will go, I don't know, up 3, 4, 5 basis points, from 7 basis points up to about maybe 10 basis points, something like that. And then the issue is as well, is if we get a hot number, is really the second question, which is, well, how long will the Fed hold the terminal rate? So we see here the terminal rate is about 5.4%. So there it is there, 5.4%. Let's call it end of January. And what you guys can see here is that the market slowly then prices in, a diminution of that or a lessening of that. But the first full cut priced in, which is 25 basis points, you could argue that it's, well, technically it's in at the July meeting, 31st of July, but you can also see here June is, got 20 or 19 basis points, or 3/4 of a chance. So essentially here we're looking around June or July for the first cut. And that's about, what's that, about 6, 7, 8 months away or so. That's what the market is pricing in. So the issue here is if we get a hot number, first of all, maybe the chance of a hike will go up a little bit. But I think really the market reaction will be more pushing out the date of the first cut. I think that's really it. It's not so much maybe that the Fed will hike, because in order for the Fed to hike, I think we'd probably have to see successive data points, maybe this CPI, the next one, and the next one. And keep in mind that before the next meeting, we do get another CPI, and we also get another non-farm payroll. So this is, there's quite a little bit more data for the Fed to digest. So I think the first thing is that if we do get a hike, if we do get a sort of a hot number, that pricing for the first cut could be pushed out from June, July to maybe sort of July or September meeting or something like that. So we could see a little bit of action there. On the other hand, of course, if we get a very weak number today, a soft number, a cool number, I think the first thing is that, these sort of, let's say for December and January, that 7 basis points will probably go down to, 1 or 2. That'll probably go down 4 or 5. So there's quite a lot of scope on the downside of dovishness for the market to price that out. And again, looking a bit further out the curve, maybe what the market will do will actually bring it closer the date for the first cut. So maybe this sort of June number, instead of being 19, that might go up might go up to 23, 24 basis points. And maybe even in May, we might see this number go up a little bit more. So that's the way to be playing it here. Now, and just in terms of the charts and everything, I think it's pretty simple. Like, first of all, just start with the bonds. So let's just look at the price action here of let's say the ZT, and we can see that over the last week, we had a little bit of if we where are we? If we actually look, we see that here Powell on Thursday was a bit hawkish, so we got a bit of a red candle there. But at this point, you've got to say, how much further can the 2-year go down? If we say that, maximum hawkishness, we could price in another, maybe 10 basis points or something like that, 10, 15 basis points. So can this go down? Yes, but it's probably unlikely to go further than like make a new high or so. But it could push down a little bit. I think if we get a hot number, definitely the 2-year will sell off hard. The 2-year will sell off hard. Further out the curve, maybe not so much, but all of the bonds should go down. But in terms of the curve, what we should see is a front end led, so led by, let's say, the 2-year bear flattener. Okay, so we should see a bear flattening of the curve on a hot number. In terms of the equities on a hot number, we know that they're interest rate sensitive, especially something like NASDAQ. And we can see that if we just look on a daily chart here, that NASDAQ and the ES, they're at pretty sort of significant levels here. For sure, I think we can see a retest down here of 15 to 50 level, absolutely on a hot number. We're also seeing that the Russell's been extremely weak. The small caps have been extremely weak. And I think on a hot number, it's no problem at all for the Russell to, maybe even test this low down here at 1645 or so. So definitely equities, at least in the short term, will not like a hot number. Of course, there's a slight irony there, because if inflation does prove to be, relatively persistent in terms of earnings, in at least nominal earnings, so earnings not adjusted for inflation, but nominal earnings, technically, might go up, which, in theory, could juice the earnings and the income of at least on a nominal basis of equities. But I think in the short term, the equities will definitely not like that. As I said, the curve we'll see the 2-year, the front end of the curve sell off. In terms of the SOFR contracts or the short-term ones, probably what I'll be hitting on a hot number, probably January would have a little bit of a boost. But I think really, maybe the way to be playing that on the short term would be, something like sort of the June or July SOFR contracts should be priced a bit more hawkishly. So their price should go down a little bit. And we can maybe just put that in here. Let's have a look. What is that? SFR. SOFR. Yeah, so if we look at, let's say, what can we look at here? maybe the June, for example, something like that. Actually not getting a great, oops, I think, did I get the wrong? Sorry, guys, cancel. Let me just see. Oh, that's a bit odd. Oh no, guys, I can't find the right symbol. They have all different symbols. Let me just check. SR3, there we go. SR3. SR3. That's the one I'm looking for. So let's say, for example, we look out to something like June 2024. You can see that's already come off quite a lot, but it has just been sort of going up over the last month or so. I think definitely this one can sell off a little bit more, basically based on this idea that the Fed is going to be a little less sort of dovish in terms of their cuts, and that has to be pushed down. Now, another thing as well would be to play a spread. So you could do a spread something like December 23 to December 24, and you could basically, on a hot number, you could you could sell that. You could essentially be buying December 23 based on the idea that that's not going to move too much. But December 24, you could be selling that based on the idea that the Fed would be cutting less in that year. And if we actually look at that spread, I think I've got it here somewhere. Let's have a look. Yeah, so Z23, oh, hold on. What's this one here? Yeah, Z23 to Z. So December 23 to December 24. You can see at this point in that time frame, that 12-month time frame, the market is discounting about 85 basis points. So that's essentially 85 basis points worth of cuts. I do believe that that number would maybe go back down here towards would go in a little bit more, maybe to 75 or something like that. So essentially less cuts. That's the way to be playing that. Gold, in theory, on a hot number, should fall down more. By the way, gold, just talking about gold, at an interesting level here. It's around a bunch of sort of 100 and 200-day moving averages. It's come back down to its 38% fib zone. There's a little bit of horizontal sort of volume support here as well. So quite an interesting sort of day for gold at this point. And again, if these numbers do come in a little bit hotter, in theory, that should be a negative for gold. In theory, it should be a positive for the US dollar. Although the dollar here, for sure that should push up a little bit here, at least back up to maybe this level here, which is some kind of resistance, 105.8. So all of those, that should be things. So be selling equities, especially the NASDAQ and maybe the Russell. One would be selling the short end. There would be a bear flattener. One would be selling the short-term SOFR contracts, but especially I'd say mid-24, so maybe June 24, something like that. In terms of the spread on the SOFR contracts, I would be playing for less rate cuts. So it's priced in for 85 basis points of rate cuts. I'll be doing that for 75 basis points for rate cuts and be selling gold as well. Now, in terms of a soft number, of course, it's going to be the opposite. A soft number, absolutely opposite. We should see the dollar index sell off. We might get a little bit of a bounce in the JPY and the euro. You could be buying the front end. So again, that should be good for all bonds, but especially the front end. You could be buying the 2-year. That should lead to a front end led bull steepener. So the front end yields come down more aggressively than the back end yields, which would lead to a steepening of the curve. Gold should pop on that. And I think the equities, as we just saw, the equities at a very interesting level. And if we look at something like the SPX, you can see that that's pushing above this level here, or even on the ES1 contract at a pretty key horizontal level there, 44, about 30-ish. And I think that like a dovish number, a less than expected number, for sure we could start to test another 40, 50, 60 points higher on the ES. Okay, guys, I'll leave it there. Hope that's useful, and we'll keep on talking, no doubt, tomorrow. Thanks very much, and have a great day. Good luck trading. Thank you.